Hello, friends. Right now, the IRS is taking money from your Social Security check, and the majority of the 75 million Americans receiving benefits either do not know it is happening, do not know how much they are losing, or do not know that a brand new law passed in 2026 may be able to stop it. Here is the number that should shock you. Up to 85% of your Social Security benefit is taxable. Not 5%, not 10%. 85% of every dollar you receive from Social Security can be counted as taxable income by the IRS. And here's what makes this worse. The income thresholds that determine how much of your benefit gets taxed have not been updated since 1983 and 1993. They have never been adjusted for inflation, not once. In over 40 years, that means a threshold designed in 1983 for a senior earning $25,000 per year is still the same threshold today, even though $25,000 in 1983 is equivalent to over $80,000 in purchasing power today. Before we get into it, subscribe to this channel right now and turn on the bell. Changes like these arrive without personal letters and without reminders. The people subscribed here find out while there's still time to act. Subscribe now and let's get into it. Today I'm going through exactly how the IRS calculates Social Security taxes, which income levels trigger each level of taxation, what the new 2026 deduction means for your specific situation, and the one action you need to take before December 31st to protect as much of your benefit as possible. Let me start with the calculation, because most people who know Social Security can be taxed do not know how the IRS actually decides how much of it to tax. The IRS does not look at your Social Security income alone. They look at something called your combined income, also known as provisional income, and that number is calculated using a formula that most seniors have never seen explained clearly. Your combined income equals your adjusted gross income. That is, everything you earn from wages, pensions, dividends, and retirement account withdrawals, plus any non-taxable interest you receive, plus 50% of your total Social Security benefit for the year. Now here is where the shock is. That combined income number is compared to 3 thresholds, and those thresholds determine whether you pay 0, 50%, or 85% of your benefit in taxes. If your combined income is below $25,000 as a single filer or below $32,000 as a married couple filing jointly, none of your Social Security benefit is taxable. 0. If your combined income is between $25,000 and $34,000 as a single filer, or between $32,000 and $44,000 as a married couple, up to 50% of your Social Security benefit becomes taxable. And if your combined income exceeds $34,000 as a single filer or $44,000 as a married couple, up to 85% of your Social Security benefit is subject to federal income tax. Now let me show you what these numbers mean in real dollars, because that is where most people finally understand how much they are actually losing. Take a married couple where the higher earner receives $2,071 per month in Social Security. The current average benefit, that is $24,852 per year in Social Security income. If that same couple also receives a pension of $20,000 per year and interest income of $2,000 per year, their combined income calculation looks like this: $20,000 pension plus $2,000 interest plus 50% of $24,852, which is $12,426, equals $34,426. That combined income of $34,426 puts this couple just above the $32,000 married threshold, and above the $34,000 upper threshold, meaning up to 85% of their Social Security benefit is taxable. 85% of $24,852 is $21,124. That is how much of their Social Security benefit is subject to federal income tax. Not the total, but $21,000 of AT, even a modest 22% federal tax rate. That couple is paying $4,647 per year in federal income taxes on money they already paid into Social Security for their entire working lives. $4,647 per year every year on money they earned, on money they paid into the system, on a benefit they were promised was theirs. Now here is the part of this video that most people need to hear, because there is something that changed in 2026 that can significantly reduce or eliminate this tax bill for millions of seniors, and most of them have no idea it exists. That on July 4th, 2025, President Trump signed the One Big Beautiful Bill into law. Inside that bill was a provision that created a brand new $6,000 additional tax deduction specifically for Americans who are 65 years old or older. This is not a tax credit. It is a deduction. That means it reduces the amount of your income that gets taxed. And because it reduces your adjusted gross income, it can also reduce your combined income, which is the number that determines how much of your Social Security benefit is taxable. Here is who qualifies for the full $6,000 déduction. Single filers who are 65 or older with a modified adjusted gross income up to $75,000 per year can claim the full amount. Married couples filing jointly who are 65 or older, at least one spouse with combined income up to $150,000 per year can claim the full $6,000. The deduction begins to phase out for single filers with income above $75,000 and disappears entirely at $175,000. For married couples, it phases out above $150,000 and disappears at $250,000. The deduction runs through the 2028 tax year. It is not permanent. It applies to tax years 2025, 2026, 2027, and 2028. After that, it expires unless Congress extends it. And here is the most important part of the deduction for Social Security recipients specifically, because the deduction reduces your adjusted gross income, it can pull your combined income, the number the IRS uses to determine Social Security taxability, below one of the thresholds, and crossing back below a threshold can change whether 0, 50, or 85% of your benefit is taxed. Let me show you exactly what that means using the same couple from earlier. Combined income of $34,426 in the 85% tax zone. Now apply the $6,000 deduction to their adjusted gross income. Their combined income drops to $28,426, $28,426. That number is now below the $32,000 married threshold, meaning this couple has moved from the 85% zone to the 50% zone with one deduction. Now, instead of 85% of their Social Security being taxable, only 50% is. Instead of $21,124 being taxable, now $12,426 is taxable. That is $8,698 less taxable Social Security income. That a 22% federal tax rate. That couple just saved $1,913 per year in federal taxes from one $6,000 deduction they may not even know they qualify for. And for some couples, the math is even more dramatic. If the deduction moves their combined income below the $32,000 threshold entirely. Their Social Security taxation drops from 50% to 0, not reduced, eliminated. Now let me tell you about other strategies that can reduce your combined income, because the $6,000 deduction is powerful, but it is not the only tool available to you. Strategy 1. Qualified Charitable Distributions, QCDs. If you are 70.5 years old or older and you have a traditional IRA, you can donate directly from your IRA to a qualified charity up to $105,000 per year in 2026, and that donation never counts as income on your tax return. It reduces your adjusted gross income directly, because QCDs reduce your adjusted gross income before the combined income calculation. They reduce the amount the IRS uses to determine how much of your Social Security is taxable. A $10,000 QCD can reduce your combined income by $10,000, which could move you below a threshold entirely. Strategy 2. Roth Conversions. If you have money in a traditional IRA or 401k, converting some of it to a Roth IRA now before you reach the age when required minimum distributions kick in reduces the amount of future mandatory withdrawals that will count toward your combined income in future years. Strategy 3. Health Savings Accounts. If you're under 65 and still enrolled in a high-deductible health plan, contributions to an HSA reduce your adjusted gross income dollar for dollar, and withdrawals for qualified medical expenses are completely tax-free. Now let me give you the exact action steps for this tax year, because knowing the strategies is only useful if you know exactly what to do with them. Action Step 1. Calculate your estimated combined income for 2026. Right now, take your adjusted gross income estimate for the year, your pension, wages, withdrawals, dividends. Add any tax-exempt interest and add 50% of your expected annual Social Security benefit. That number tells you which tax zone you are currently in. Action Step 2. If you're 65 or older, confirm that your tax preparer is claiming the $6,000 additional senior deduction when they file your 2026 federal return. If you file your own taxes, look for the additional standard deduction for senior section on Schedule A or the standard deduction worksheet for your filing status. Action Step 3. If you're 70.5 or older and you have a traditional IRA, talk to your financial advisor or IRA custodian this month about using a qualified charitable distribution before December 31st to reduce your 2026 adjusted gross income. The QCD must be completed by December 31st to count for the 2026 tax year. Action Step 4. If you filed your 2025 taxes without claiming the $6,000 deduction because the law was new and your preparer missed it, you can file an amended return using Form 1040X. The window to amend a federal return is generally 3 years from the original filing deadline. That means your 2025 return can still be amended until April 2028. Action Step 5. If your combined income is currently above the 85% threshold and you believe it will be in future years as well, talk to a tax professional specifically about a Roth conversion strategy before required minimum distributions begin at age 73. The earlier you act on this, the more years of tax-free growth you protect. Now let me address the one mistake that costs seniors the most money in this entire area, and it is a mistake made by millions of people who think they're doing everything right. The mistake is taking Social Security at 62 while still withdrawing heavily from a traditional IRA, because those IRA withdrawals count toward combined income, and combined with even a modest Social Security benefit, they frequently push retirees into the 85% tax zone before they realize what happened. The combination of early Social Security plus large IRA withdrawals is one of the most common and most expensive retirement tax mistakes in America today, and it is almost always the result of planning each piece in isolation rather than seeing how they interact with each other. So here is the complete picture of how the IRS taxes Social Security and what you can do about it. Before December 31, up to 85% of your Social Security benefit is taxable. The IRS determines how much using your combined income, adjusted gross income plus tax-exempt interest, plus 50% of your Social Security benefit. The three tax zones are 0% if combined income is below $25,000 single or $32,000 married, 50% taxable if between those numbers and $34,000 single or $44,000 married, and 85% taxable above those upper thresholds. The new $6,000 senior deduction available to anyone 65 or older with income below the phase-out levels can reduce your adjusted gross income and therefore reduce your combined income, potentially moving you into a lower Social Security tax zone or out of taxation entirely. Additional tools include qualified charitable distributions for those 70 and a half and older, Roth conversions before required minimum distributions begin at 73, and health savings account contributions for those still under 65. The IRS is not sending you a letter explaining how to reduce your Social Security tax bill. Your tax preparer may not be proactively asking whether you are in the best position, and the thresholds that determine your tax zone have not been updated since 1983, when most of the people watching this video were still decades away from retirement. Calculate your combined income. Confirm the $6,000 deduction is on your return. Ask about QCDs before December 31st. And if your Social Security tax bill surprises you when you read this, take that surprise to a tax professional this week, not in April, when it is too late to change anything about the year that is still in progress. Subscribe. Share this with someone you know on Social Security, especially anyone whose tax bill shocked them this year, anyone approaching 65, and anyone with a traditional IRA they are still drawing from. And I will see you in the next one.